Good afternoon and a warm welcome to all our FFA clients and FFA guests. It is fantastic you can join us this afternoon. Well, this is not the first time we've spoken to Sean Fenton from Sage Capital in this type of forum. It is a forum we like to provide access for our clients, and our investment committee's main goal is really to get you closer to the inner workings of how FFA manage money and how we're not only thinking about return drivers, but also incorporate important risk mitigators. We're always educating our clients here at FFA. And you know, when we have significant market drawdowns, you do not want a situation where you invest, let's say, $1 and you endure quite a hefty negative return. Let's use round numbers of 50%. That would mean that dollar would now be equal to 50 cents. You would have to earn 100% on your 50 cents just to get back to $1. That example indeed demonstrates the importance of why FFA's investment committee focuses on downside protection so those scenarios do not happen. So we want to discuss and unpack some of today, which will include some question time towards the end with a chat box function. If you are handy with the keyboard, by all means, plug your questions in there and we'll see them come through. However, before we do so, I'd like to show you a disclaimer. It's important that everyone on this afternoon's webinar, excuse me, while I change my screens. It's important that everyone on this afternoon's webinar understands the session is in general in nature and is not personal advice. Of course, should you want more detail, please do not hesitate to contact our office and ask our advisors. They'll be happy to assist. So please allow me to introduce Sean Fenton. Sean is Managing Director and founder of Sage Capital. Sean is a highly experienced fundamental and quantitative investor with more than 25 years experience managing Australian equity investments. Prior to founding Sage Capital in 2019, Sean was portfolio manager at Tribeca Investment Partners, where he managed the Alpha Long Short Fund since its inception. Sean commenced his investment career at Credit Suisse, where he spent 4 years evaluating companies on the sell side and providing equity strategy research. So welcome, Sean.
Thank you. Good to be here.
So let me explain to our FFA audience today why we've included the Sage Absolute Return Fund into our portfolios around 2 years ago. And to be quite clear, there were two main objectives, and there are still two main objectives. First, we wanted to broaden out our alternative asset class lead within our portfolios, leading to added diversification and inherently reducing our portfolio's risk without compromising on return. In addition, we wanted to deploy an investment strategy that can not only produce good returns in bull markets, however, can also deliver positive return outcomes in bear markets. And we've certainly seen this to be the case with the inclusion of Sage's Absolute Return Fund in FFA's portfolio. And just having a look at Sage's performance numbers till the end of August, the strategy has demonstrated the need for exposure to active fund managers, with the fund's loss standard deviation far less than the ASX 200 index, which has contributed to an impressive outperformance of 11.2% compound over this index since inception. So congratulations, Sean.
Thank you.
So Sean, before I ask some questions about the absolute return strategy that our clients have exposure to, let's start by talking about your investment philosophy. Can you tell us a bit about what got you into investing and why are you so passionate about financial markets?
Yeah, I guess I've had a bit of an interest in investing in markets from a young age. It's probably my first introduction to the share market was my father. He ran a small business, had his own self-managed super fund. So he invested in shares directly, and as a kid bought some for me in my name as well. So one of the few teenagers probably reading the paper on a Saturday morning, looking at how stock prices traded the previous day. So since that time, I've had an interest in the equity market. I guess I've got an inherent interest in how things work as well, and that extends from I guess, the world and how bits and pieces fit together, but economies and markets and structure and even people, how they interact and work together. So I find markets are a very stimulating, rewarding environment to work in terms of you get a real insight in terms of how the world works, makes money, and how capital comes to create these amazing outcomes that we have in our society today. So investing is something I've been looking at for a long time, and it's something that's constantly changing and challenging and rewarding. So whilst it's got its ups and downs, I find it something that's very stimulating and it gives a lot back.
It's interesting you say when you're younger and your father. I certainly remember as a kid looking up at the business section and trying to find the stocks I owned with a magnifying glass in the big age section. It was, so we've certainly got some alignment there. You spent your entire career in equity markets. Can you share some highlights in terms of key learnings and experiences?
Yeah, I think the key learnings often stick around the periods of greatest volatility. So the things that stick in my mind, one of my first introductions to the markets was back in when I joined AMP in '97. So not long after that, the world hit sort of the Asia Russian bond crisis, emerging market currency crisis, and from that you saw how quickly demand could change. So we went from these tiger economies growing really strongly to a sudden shift in policy and tighter liquidity offshore in the US, and suddenly things break down and resources collapse and commodities collapse. So that really sticks in my mind. I remember the dot-com bubble intimately, where I'm, I guess, lucky enough to have been through the journey of personal computers and the evolution of the internet and seeing it come to fruition and grow. And even back in the late 90s, there's an amazing sense of growth and change in the world and the opportunity. And there's some great investment returns there. But then the excessive optimism and exuberance and loose money that really built that up into a bubble and the eventual correction. So I guess some of those experiences, really sticks in your mind that equities markets, they offer amazing opportunity to generate capital and wealth, and being along for the ride in some of those companies that are changing the world and changing the economy and being involved there, but always the need for a bit of a grounding in reality to understand where there's actual value there and where risk lies and how quickly things can change. So to be very balanced and measured in the approach. And that's what I think one of the key skills in equity investing is to recognize the opportunity and the need to take risk and pursue growth and capital, but also the conservatism and the cynicism of looking at things in terms of potentially being overinflated and risky and having some grounding there.
Yeah, it's a good point. Looking at companies that are really good companies, but they may not provide value for shareholders at an entry point at a certain period of time. So understanding when that value is there and when to pull the trigger is definitely a skill, and something that we're really impressed how you've managed your way over the last few years in particular. So as a boutique investment manager running your own business investment team, I think has that been a massive change from where you were as a research analyst coming all the way up to where you sit today?
Yes and no. I think if you spoke to anyone in our team, they'd tell you I'm a very hands-off manager. So what we've really tried to create at Sage is some smart, independent, freely thinking people that are prepared to find their own way and contribute wherever they can. So as a team, we cover a lot of bases and do things. What's I think really different for us is actually owning our own business and being in control of our destiny and what we do and be able to be hands-on there. But in terms of the actual day-to-day running the business, we're very lucky to have Channel Capital as our partners who do not just our marketing distribution for us, but they essentially do the actual running of the business. So we pretty much outsource to them the HR, payroll, legal, compliance, tax, IT, infrastructure, which really just frees us up to focus on the investing side of things. And I think that's it is a real advantage because running a business does take a lot of time, and we think our time's better spent focusing on the investing rather than doing the hard yards there sometimes.
Absolutely, that's really important to note there. Sticking to your knitting is a good way to making sure you're focused and concentrated on what you're doing. So you're a specialist manager in the long, short Australian equity space. How about you explain what long and short investing is to our client cohort, and why do people invest through a long, short strategy?
Yeah, so sometimes you see shorting get some headlines in the paper, and short sellers are sort of pointed out as being negative and targeting things and looking for companies to collapse or something like that. We take a very different view of long short investing. For us, it's all about flexibility to express our investment ideas as freely as possible. So if you think about the absolute return fund and what it's offering, what it's really offering is the ability to, I guess, tap into our stock selection skill across a broad range of stocks. So we're being short, we're being long. When we're shorting a stock, we're essentially borrowing some of that stock from, say, an index fund that holds it passively and selling it and raising cash. With that cash, we can then go out and buy another long stock. And we can do this repeatedly and have a range of long and short positions across the portfolio. So what we're actually doing is building a diverse portfolio of long and short positions that really reflect our investment views around the relative performance of those companies. So it allows us to do a couple of things, which is, yes, you can profit from companies going both up and down in different markets, but it enables us to actually strip out a lot of really directional, systematic risks in the market. So the big important one is we can strip out whether the market's going up and down. So we tend to run very low net exposure. So we balance our longs and shorts out so that the performance of our funds completely uncorrelated with the direction of the underlying stock market. It's just the underlying stock selection that's really driving our returns. And we can even further break that down to control some other risks that go through the market, which might be, in some environments, value style stocks might be in favour, and other environments might be growth, big cap and small cap, or we may be going into recession, so economic sensitivity and leverage. So we can take a broad range of positions that balance these out. So we might look for the best stocks within value, the best stocks within growth, the best small caps, the best large caps, and be long and short in all of those different areas so that the fund doesn't have a lot of risky directional tilts to it. It's just relying on the broad stock selection and that broad diversified portfolio to generate uncorrelated returns to other asset classes.
Yeah, that's certainly key at investment community level, to ensure we have uncorrelated strategies within the fund. So when things are powering along, or things aren't powering along, there's other levers that can be doing the heavy lifting in distressed times. And certainly your fund in particular has done that for our clients during this testing period. Yeah. So the differentiated investment process, can you provide and dissect how you analyze the markets and stocks? I know it's a really broad question, but if you could sort of provide some detail on how that all sort of pans out, that'd be great.
Yep. So at a very core level, we're really focused on company earnings. That's where we think we can provide the most insight in terms of what drives stock returns in the medium and long term. Is generally a company that delivers the best earnings growth will actually have the best outcome, and vice versa. So that's where we focus, but we do that in two different ways. The first thing we do, as I just mentioned before, we try and strip out some of those systematic directional biases. So we make the job easier for us. We break the market down into 8 broad areas, and we really look to select stocks within each of those. So they're things like defensive stocks or cyclicals, growth stocks, REITs, yield like banks and insurers, resources, gold, those sort of things. So once we've got those 8 groups, we're really looking to select the best and worst stocks within there. And we've got a 2-stage process to do that. The first stage is we use a broad quantitative systematic ranking approach to actually rank stocks right across the market within each of those groups using a range of different proven factors that drive performance. They're things like momentum, which will be things like underlying earnings revisions and changes and direction of recommendations or target prices. And there you're really trying to capture the fact that people underestimate structural changes and how they drive, and earnings and stock prices often trend in a direction. The other areas we look at are value and quality. So as we mentioned before, even though you found a great stock, you always want to anchor your expected return in what you're paying for it now, and how much value is there in terms of where you think earnings are going to move to in the future, and how uncertain and volatile those earnings are. So that quantitative rankings, combining momentum, value and quality to identify stocks that are a good balance of, we see likely increases in earnings that are reasonably well priced at this point to be long stocks, and similarly stocks subject to downgrade in terms of the shorts. So that's great. It's a good, powerful process. Its strength is that it gives a lot of breadth to your investment process, but it can be a little bit more superficial in terms of the detail that it goes down to in terms of analysing companies. And that's where we really want the experience of the investment team to add some incremental value. So we've still also got a broad fundamental process where we're doing more detailed modelling of the company to understand what its particular earnings drivers are, be it top-down things like what's happening to the overall top-line revenue growth or competition in the industry and how that might be changing, what barriers to entry there are, down to specific things like management quality and incentive structures and operating financial leverage. So we'll do more detailed modelling of companies' earnings and identify situations where we've got some insight in terms of expected changes in those earnings. And once again, we've got a strong valuation framework to parameterize that. So we're combining the two of those together, the broader quantitative systematic ranking with that in-depth insight from the analyst team in terms of understanding the nitty-gritty of the companies.
So we see a lot of geopolitical issues in our environment in the last, well, it's always going to be there, but certainly heightened in the last 12, 18 months, 2 years, even longer, really. I know that, the market neutral strategy has performed well during this period. Apart from the market neutrality piece, can you perhaps give us some insight into how you manage that with individual stock selections around this geopolitical tinderbox we face?
Yeah, so as I touched on before, on the fundamental side, we are looking at broad industry dynamics as well as what's happening. So rather than just looking at the company, speaking to management and seeing how they're going and doing some valuation work, we look at the broad industry setting that they're operating in and some of those big forces that are at play. And different companies are more exposed in different ways to those geopolitical risks, and depending on what's happening, things can be very different. So you can characterize COVID potentially as a geopolitical risk. It was a big global disruption, really centered around the freedom of movement of people across borders, and had massive impacts on different companies. Obviously, things like the travel industry were impacted, whereas online shopping received a big boost. So having an investment process where we're flexible enough to take those things into consideration, or if you look more recently in terms of, say, Russia's invasion of Ukraine, we can very quickly go, well, what's the impact of that? Russia's a massive energy producer, exports something like 20-25% of the world's refined diesel, as well as oil and gas, obviously a lot of gas to Europe. Russia and Ukraine are massive producers of wheat, so has implications for the price of wheat and food security and food inflation as well. So you can look at that disruption and understand what companies are impacted in different ways. So wheat prices shot up. Grain Corp did very well, making some trading profits there, so it's a big beneficiary. The cut off the supply of gas into Europe. There's a whole lot of fertilizer plants that have been shutting down across Europe, which is going to end up driving up the price of fertilizers, which is beneficial to someone like Incitec Pivot, who has operations in Australia and the US in terms of manufacturing fertilizer with increasing gas prices, but still much cheaper than German, UK gas prices, and receiving a bit of a benefit there. So understanding how those different dynamics change. China, we've obviously been through trade disputes from taxes on things like exports of wine, which had a big impact on Treasury wine. We exported oodles of iron ore, which to date haven't been impacted, but a looming geopolitical risk is around obviously China, Taiwan, and is there a potential move there, and how would the world respond? Would there be sanctions like Russia? How would that impact Australia in terms of our trade links? What happens to our iron ore exports, as well as a whole bunch of companies that are integrated up into China in terms of supply chains and manufacturing and everything else. And once you start thinking like that, it's a real headache, and you just hope nothing happens there, because that is going to be very complicating for the world. But I think the flexibility of our investment process, where we're not looking just at a cookie cutter sort of style technique, we're just trying to very broadly understand what's driving the company's earnings, and as much from top-down forces where appropriate, we need to be on top of those and take those into account in terms of our assessment of where earnings are going for a company.
So you've obviously been managing money in this market neutrality sense for a long period of time. How does the process work through the fullness of time with market cycles and so on?
Yes, it's generally, and even Sage has only been running for 3 years, but even through that period of time, we've had some radically different market cycles. I mentioned COVID before and lockdowns, and we had a significant bear market. Then we had some booming recovery with a lot of fiscal stimulus and monetary support. We've been through a recovery and reopening vaccination environment. Now we're into a high inflation environment and central bank tightening and potentially moving to recession. So the fund's been able to perform pretty consistently across those different environments. And that's because we do have that that focus on keeping those big directional tilts out of the portfolio. And if you go back and look at the experience at Tribeca before that, and even experience at AMP managing money before that, we've generally been able to do it pretty consistently. You always have periods where you may have a drawdown in the fund as your investment insights aren't necessarily rewarded in every particular market, but generally uncorrelated with certainly the direction of the market movement. So we find, if anything, when the market's having big falls, that's an environment of uncertainty and change and volatility, and it's actually provides us with a lot of investment opportunities. So historically, big market drawdowns have actually been environments where we've done a bit better and managed to add value. So they're certainly not something we fear, but something we pay a lot of attention to.
So true. So there's an absolute obsession with long-term investing and almost a back to basics approach to investing. And as a firm, as an investment committee, we need to balance the blend between long-term investing and short-term to take advantage of the opportunities. So that must be, I know you've touched on it, but that must be, or how do you balance that in the first point?
Yeah, it's a great question. And I don't know who said this, and so I'll just claim it for myself, but the long term is made up of a series of short terms. And you've always got to focus on that as well. And the difficult thing in investing is there's a lot of noise in the short term. So you've got to be cognizant of, am I just in a period of noise? Do I need to react to it? Or is this part of a trend? And, if you've been in a period of noise for a couple of years, well, that's not just noise, you've missed something. So we're always trying to balance, return against risk control. So, we do things and look at what's performing in the fund, what's not performing. We try and establish, have we missed something? What's changed there? So we're constantly challenging ourselves in terms of keeping the portfolio refreshed, and we don't want to be sitting in stale positions where we've potentially missed something. That said, though, there is a lot of volatility, and sometimes you just need to stick with it and ride it through. And investing is often finding the right balance there between being disciplined to cut positions where you can identify you've missed something or made a mistake, versus sticking with your conviction and your insights as you go forward. But you do need to be, I think, aware that sooner or later the short run moves into the long run, and if you haven't got something right, you need to change something, and you need to have the discipline around doing that.
So we saw back in 2020 with the pandemic, and then a few months later there was talk of the vaccine, and there was a run up in growth stocks during that period, and then the vaccine came out, and obviously value started playing a reasonably big thematic. Is that mean reverting playing out and continuing through the fullness of time. Where are your thoughts on that value growth debate?
Yeah, when we look at value versus growth, I think one of the big underlying drivers is central banks and really where real interest rates are, and central banks have an outsized impact on where interest rates are. And if you look at the relative performance of value and growth, it really follows that interest rate cycle. So particularly post GFC, where central banks are trying to stimulate economies that have been scarred, and they pushed interest rates below inflation. You had negative real rates. That's a really positive environment for stocks that have growth and duration, and that means you saw valuation models expand and growth do very well there. What we've seen more recently, obviously, inflation's broken out and central banks have gone, oh, hang on, policy's way too loose. We need to start tightening that up. And you've seen real yields start to push back higher again. And US long-term treasury, Australian long-term bond yields have moved back into positive territory. And you've seen broadly value outperform growth as a result of that. So it's essentially a duration question in terms of how much value you put on your future growth there. And we see that probably continuing as policy is kept tight going forward. I think the tricky thing for an investment point of view in terms of value versus growth at the moment is, are we going to start to see big changes in earnings? So we've gone from a period of, over the last, say, 6 to 12 months, value's done a lot better than growth as the economy's been robust, earnings have been very strong, and real bond yields have been moving higher and compressing valuations. We're now in an environment where real bond yields are probably high and still going higher, and you're probably seeing valuations compress. But in terms of the outcome of value and growth, that might be overwhelmed by changes in earnings. So if we head into a recession, a lot of those value stocks can be more cyclical. And by that, I'm including things like retailers and building materials, but also don't forget that resources, commodities are deep cyclical, late cyclical value stocks. You can start to see earnings really roll over quite heavily. And whilst you still might get multiple compression with real yields moving up, it might not be great, but growth stocks still might outperform because earnings really get trashed. So one of the things we're a bit focused on at the moment is looking for earnings quality. So that's stocks that are most resilient to an economic downturn within that value space. So areas where there's more, structural support for earnings. So some either sort of market concentration, so maybe something like Qantas, which is, airlines are quite cyclical value stocks, but you've got a duopoly there with Virgin and some pricing power and constrained capacity at the moment. Or within resources, something like either energy, where you've got OPEC backstopping supply, so they can take supply out if demand falls, or new electric vehicles where underlying demand growth and penetration could support demand, or in the growth space, you want to be clear of stocks that might have more economic sensitivity. So they might be growth stocks, but might have a flavour of REA, which is leveraged to the housing cycle and listings a little bit, or James Hardie in the building cycle. And we're probably a bit more favouring stocks like a CSL or a ResMed, where healthcare is a lot more insensitive and defensible. So we suspect growth will do better than value in that recessionary environment, but you still need to make sure you're in the best of both areas in each of those.
And I suppose, you're talking about valuations and earnings on the long side. When you come across companies that don't meet your expectation, are they automatically put on the short side, and then obviously a deep dive in that from there? Is that a lot of the opportunities in IG generation coming from lower than expectation earnings or forecasts from those businesses?
Yeah, exactly. That's it's a good summary. So I think the best areas that we see shorting are companies that have reached maturity and undergone some structural change, and or there's increasing competitive pressures. And there's been some examples of that over the years, say like A2 milk, where you've had competition come in, shine domestically in the infant milk formula space, or up until recently, AGL, where you're seeing electricity prices under pressure, retailing margins through competition. Back when Aldi moved into the supermarket space, it was a bit disruptive. There's a period of time there. So those sort of things can really pressure earnings, or where you see companies making bad investment decisions and overpaying for acquisitions and those sort of things. Or could just be valuation. So a company just could become quite expensive for what it's offering and fall into the short side that way.
So thanks, Sean. So before we move on to the market, the outlook and the Sage Absolute Return Fund itself, remind you that we do have a chat function on the Zoom chat area. If you wish to ask a question, certainly type your question in there, and I'll endeavour to ask those questions to Sean and answer those for you. So in terms of impacts closer to home, China's weakened economy is definitely a problem for the Australian economy, in that 40% of our exports go to China, and we're largely an export-dependent economy. If you then combine that with the RBA moves to tame inflation, which is putting pressure on the housing market and construction, it doesn't bode well. However, you're seeing that playing out in the Aussie dollar, I think, at the moment as well, coming off of late. But these sort of times, aren't. These are ripe for a strategy like yours. Could you maybe back over a little bit of what you've gone through already and explain why in layman term?
Yeah, so there's some good examples there, I think. And China's, I think, fascinating at the moment. It's our largest trading partner, as you say, and they're undergoing some pretty serious structural reform themselves. And China's been very much at the root of a lot of forces driving through global markets over the last couple of decades. So, if you go right back to China joining the World Trade Organization back in 2001, you've seen a massive explosion in capital investment and manufacturing capacity, and tapping into building low-cost workers and driving really deflation in tradable goods all around the world. And that's really backstopped low inflation and allowed central banks to run pretty easy policy for much of the last couple of decades. And as we touched on a little bit earlier, with a lot of trade tensions around China and some pushback there, what we've seen with COVID in terms of supply chain disruption, you're starting to see a big push for more local investment, more local manufacturing, local fulfillment, shortening supply chains there as well. And China's sort of probably reached a peak in terms of its share of manufactured goods, and its influence on deflation there has probably waned a little bit. The other big thing changing in China, structurally, there's a few things. Is you sort of coming to the end of that sort of urbanization growth surge. You've got a population now that's actually aging. The working age population, the workforce is shrinking. And you've got a market where housing investment has been more rampant, speculative than it has in Australia. And they're trying to restructure the economy away from there. So a couple of years ago, President Xi mentioned that housing was for living, not speculating, and followed that up by introducing the 3 red lines on domestic property developers to limit their access to credit and their leverage. And that's kicked off a process of downturn in the Chinese property developers. It's become a little disorderly, whereas they had development models where they basically funded their developments by pre-selling 100% of them, and they're raising the cash up front. But some of that money's slipped out into different areas, and with the tightening in credit, their access to funds dried up. They haven't been able to complete projects, and they've actually then their pre-sales have fallen, so they've got less money coming in. And this cycle has all started unwinding. And you've seen Evergrande obviously go bankrupt and kick off a range of bankruptcies there. You've now got land sales down like 40% year on year, and housing starts down 30+% year on year in China. House prices, which are actually tightly managed, much of sort of regulatory intervention in China, actually falling once again year over year. They haven't for a couple of down cycles. So to us, it looks very much like you're at peak demand for steel in China. Steel demands are also been boosted by goods demand for manufactured goods as people shifted spending from services to goods during COVID, and some of that's all unwinding. And China's been doing a little bit in terms of easing policy, lowering mortgage rates, making access to mortgages a little bit easier, spending a bit more money on infrastructure, trying to get money into the hands of the local governments to keep things going. But broadly, the economy is slowing quite a lot. And it's not entirely clear they're committed to actually doing big stimulus to turn that around, as opposed to trying to restructure the economy, get the focus away from property development so much and more towards high-tech manufacturing and consumption and broader development there. And I guess a real critical point is going to be 16th of October, where you've got the People's Congress and the election, and G will actually be elected for a third term. And there's some expectation that after that, that he'll loosen the taps and create a sense of positivity around his new term and leader for life status, and they'll kick off some stimulus. But we're sceptical in that they've actually shown very little intention to actually change that structural reform that's swept right through things like the tech sector and what happened with Tencent and Alibaba and the like, and really that surge to greater control with the Communist Party. So there's some real, I guess, threats there for us in terms of our major trading partner. The other thing always worth bearing in mind with China, might be getting too much detail, but they do run a pretty fixed exchange rate with the US dollar. And when you run a fixed exchange rate like that, you give up some of the control around your own monetary policy and liquidity. And what you've been seeing is the yuan's been devaluing, falling against the US dollar quite sharply in recent times, because the US has been raising rates and they've been holding and cutting a little bit. Same reason why the Aussie dollar has been coming under a little bit of pressure. So it's very hard for China to actually ease their domestic liquidity conditions whilst the US is tightening rates and the US dollar is strengthening, because any attempt to do that will see capital flow out of the country, which then destroys money in the system and tightens liquidity. So we're a bit cautious around China, and as a consequence, we're reasonably much on the short side of steel-making commodities like iron ore, with our preference being, as I touched on before, for things that there's more structural supply constraints there, like EV materials like lithium or energy, even fossil fuel stocks.
So I want to take you back to February, March 2020, and I don't mind taking you back to that far, given the performance of the fund has been really impressive. What goes through Sean's mind, your mind, during a period of unprecedented, flow of information, events? What goes through your mind of a night and a typical trading day when those sort of events really occur, and how do you maintain composure?
Yeah, it's a good question. I guess we touched on a little bit before that actually tend to find change and volatility. I guess it might be my personality. I find it quite exciting in terms of things changing and developing. I think one of the key tools to being an investor is actually imagination, and being able to take yourself out of where you're sitting today and imagine a different world and how things could be different. And those environments of a lot of disruption and change provide fertile grounds for your imagination, and trying to combine your understanding of how things fit together, what could potentially happen and what might be changing. And that's what we spend a lot of our time doing, not just back with shutdowns and COVID, but even now in terms of what might happen if China invades Taiwan, or what might happen if inflation's more persistent and rates have to go higher. What will change? How will that flow through the economy? How will that impact companies? So through that COVID period, we were spending a lot of time, obviously initially tracking what was happening with the virus. So we all became amateur epidemiologists and the like. And we did notice often simple information's not necessarily priced immediately by markets. So when we started to see a big surge in deaths, in hospitalizations and deaths in places like Iran and Italy, it became clear that there's a big cohort of infected people, because we couldn't really test for it at that stage effectively, that were around. It was very contagious. It was spreading, it was popping up all over the world. We probably had a global pandemic. So whilst that uncertainty that was there, markets were actually reasonably resilient. We're actually able to identify those risks and start thinking about how companies would be impacted what those changes could be and start positioning the portfolio for where the market might start pricing risk and adjusting expectations around earnings. So doing things like selling our travel stocks and maybe going short, being a bit more cautious around credit, the risk of unemployment and economic loss, and looking at strength of balance sheets, see who the beneficiaries are in healthcare and respiratory medicine like ResMed and Fisher and Paykel and those things. So we see uncertainty and change as opportunities to employ our investment skills and think about things. And at the end of the day, as long as you're getting them right, there are often periods of stress and uncertainty, but potential for reward and actually be able to demonstrate your investment process.
Thanks, Sean. So let's talk about the fund now. You mentioned some positions earlier, but how are you positioned in the absolute return fund for the remainder of 2022? If you give us some insight there.
So everyone's probably got the sense that we're a little bit bearish at the moment, and that's underpinning a lot of our thinking and positioning at the moment. So the most critical driver for markets going forward is the path that inflation takes and how far central banks have to go to control that. Are we going to be able to have a quick pivot through next year in terms of starting to cut rates again and have a soft landing and not too much damage to earnings in the economy, or is inflation going to be a little bit more persistent and require much higher rates and more stress and a harder landing? And the thing that concerns us is there's really two different dynamics occurring within inflation at the moment. You've got the more volatile tradable goods that are driven by things like the oil price and supply chain disruptions and cost of freight and moving things around. And a lot of those forces have peaked out and they're tailing off, and we're starting to see some of that inflationary pressure ease generally right around the world. But the other part of inflation is the fact that labour markets are actually tight all around the world, and generally unemployment's at record lows, and you're starting to see that previous episode of inflation being baked into wage expectations, and companies have been reacting to that by taking price. So you're starting to see inflation broaden right out across the services sector, which actually makes up 2/3 to 70% of most advanced economies and is much more persistent and harder to get rid of, and generally pretty correlated with strength of employment markets. And that is what's got central banks focus, and that can be a lot harder to break down. So we suspect that interest rates are going to go higher than people expect, and the markets are already pricing in a fair bit of tightening there, but importantly are going to stay there for longer and maybe not come down that much afterwards. And that the end result is going to be we do see a recession and materially higher unemployment, which is what's really required to break down that transmission through to wages and get inflation under control. Australia's a bit more exposed to that than, say, the US, mainly because all of our mortgages, we've got more household debt, but it's all variable floating rate, or it will be when everything rolls off the fixed rate mortgages that we've written in the next year or so, compared to the US, which has largely got 30-year fixed rate mortgages. So that'll put the currency under pressure as well. So that's an environment which we're broadly looking for, and that there's going to be some cyclical downturn. So more interest rate sensitive areas are going to be under pressure. So in areas like cyclicals, things like retailers and builders are more likely to be under pressure. So we want to be looking for areas that I touched on before where there's some underlying support, things like Qantas or an Ampol, where there's some tightness in refining margins, and you've got broad recovery in fuel volumes to go. Within growth stocks, I touched on, we want to be focused on companies whose earnings can grow independently of the economic cycle. So healthcare is a good example there. Something like a ResMed, where their major competitor Respironics has had a product recall. ResMed's got a chance to increase its market share and really consolidate that, but haven't been able to fully take advantage of it due to computer chip shortages in manufacturing their CPAP machines. So they're gradually solving that. It's a real ongoing problem for Respironics. So we see ResMed materially growing its earnings going forward. Whereas something like an REA, listings volumes for real estate, they're more likely to come under pressure. So even in the last housing downturn, where housing prices in 2018, 19 fell 5 or 10% or something, peak to trough listing volumes were down 30%. So we want to identify earnings consistency there. Across resources, I touched on we're overweight lithium and energy, generally underweight iron ore stocks. Across financials, we want to have lower credit risk. So in the very short term, we see banks making really good profits. So net interest margins are expanding as cash rates have gone up rapidly, and lending rates are going up faster than deposit rates. And that'll give a real boost to earnings. But on the other side of that steep rise in cash rates is pressuring house prices. There's various forecasts of falls out there. But even without material losses, what you need to understand about banks is with the current capital rules around risk-weighted assets, as house prices fall, existing loans, the loan-to-value ratio goes up, and they can push into higher categories. So they might go from a 70% LVR loan to above 80%. And that means the risk weighting on that goes up. The bank has to hold more capital against it. So the risk-weighted assets of the banks will end up growing, even though that's not growing profitability. They've got to hold more capital against it, which is diluted for them. Then you're also in a recessionary environment, unemployment, so potentially bad debts and credit losses pushing up. So we're broadly a little bit more cautious on banks and looking for stocks there that have earnings that are a little bit less dependent on the economic cycle. So we like insurers. Insurance premium market's quite tight at the moment. You're still seeing strong premium rate rises. So QBE we quite like, IG Suncorp are okay, or other diversified financials like a computer share that has big cash balances. Actually, its profits are super leveraged to higher cash rates. We'll be getting material earnings upgrades going forward. So that's sort of how we're positioned. We're not necessarily, as I say, taking a big directional bet on markets in terms of being all in supermarkets and telcos and shorting everything that's cyclical and resources, but looking for companies, generally looking for higher quality earnings, less economic sensitivity, always an element of value there, and also companies are able to just do their own thing independently of a cycle, add value, or who might be in trouble for any other sort of reason. So diversification and breadth and balance are all important there.
I think at the investment committee level, we've got to make sure that, we're big proponents of active asset management, and certainly these are the times when active managers come to the forefront, and certainly we've seen that with your fund since inception. So really, I really want to thank you today, Sean, for spending some time with FFA and our client community to really bring them closer to the mechanics, and in particular, your focus on how you manage risk and return with the absolute return fund. Just want to say, keep up the impressive numbers. But to our FFA clients, on behalf of our investment committee and broader team, we really thank you for dialing in to this webinar. I would encourage you to keep an eye out for our next Meet the Manager series invitation, which will be in December. So until then, take care.